gathered today to talk about the sort of various funding options available for generally Series A and beyond companies. Everyone's familiar with the traditional equity option, selling shares, but there's a growing number of options in the Australia, New Zealand region. Sorry, can't hear? Cool. And so we're going to be diving a bit more into that. We've got great panelists. We've got topics from the secondaries. We've got pure equity. We've got venture debt. We've got revenue-based finance. And I'm going to ask the panelists quickly, starting with Ian, to give a sort of a 1-minute intro into you and your fund. And then we carry on from there.
Thanks, Amit. Good morning, everyone. My name's Ian Beattie. I'm the co-founder and managing partner of Second Quarter Ventures. We're a secondaries fund. What that means is, unlike traditional VC funds, we engineer exposures to great growing technology startups by buying shares from existing shareholders. So we buy shares from founders, from friends and family who committed early on, angel investors, sometimes venture capital investors, and very importantly, employees. We're the only dedicated secondaries fund in Australia, and we were set up about 2 years ago. We've got a great team of general partners. There are 4 of us. One of them is Lee Jasper, who many people in this room might know, the co-founder of Aconex, and Sam Cronenberg, the founder of A Cloud Guru, is a venture partner. So we've got a great team, and our mission is to help the people supporting and creating the value along that startup journey realize some of that value they've created along the way in the form of cash to make their journey a bit better.
Hey everyone, my name's Chris Skillings. I am in the VC team at a company called 5V. So 5V is probably more well known in the Australian market as a private equity firm. So we're on our 4th private equity fund, investing in mid-market, so deploying capital into sort of $300 million enterprise type businesses. The VC fund is on its 2nd fund. I just joined 6 months ago to join that 2nd fund. It's a $100 million fund investing in Series A, Series B software companies. We are looking to deploy anywhere between $3 to $6 million as a first check, and then follow on as much as possible. So I think one of the big differentiators for us from a portfolio perspective is that we are pretty high conviction. So that $100 million is only going to go to around 20 companies or fewer. So we're looking to, invest in those 20 companies and then double down on, 10 of those companies, and then really continue to support, the sort of the top performers in the fund. Our value proposition to founders is that we are, unashamedly part of this sort of private equity ecosystem as well. So we have very different networks from a lot of our peers. Our private equity team is much larger than ours. They have amazing networks into sort of larger companies, from ASX listed corporates through to sort of very, very large family-owned businesses. I also run an angel syndicate called Cut Through Angels. We invest in seed stage and pre-seed stage companies, investing up to $300,000. We have an angel network of currently 300. It's an open and free angel network. We charge very, very low fees compared to some others. And you can sign up for that if you want at cutthroughangels.com.
Morning, my name is Justine. So I'm an investment director at One Ventures based here in Melbourne. One Ventures is a multi-strategy VC firm. Effectively, we have a number of funds that invest equity into drug and medical device pipelines, but then we also have an entire side of our business that invests in technology. Within that business, we have a number of growth equity funds. Our current live one, Growth Fund 5, is a $140 million fund, which invests checks up to $20 million. But then a large part of our business, and the business where I sit, is our venture debt business. And within there, we have our first fund, which launched about 4 years ago. It was an $80 million fund investing in technology across marketing tech, education tech, prop tech. It doesn't have to be B2B SaaS or recurring, although that's always nice, but we like to take a really holistic approach and invest just like any other VC would. We write checks anywhere between 1.5 million to 20 million, and we typically operate in a slightly later stage. So we'll usually start around Series A all the way through to pre-IPO, and actually we also have some post-IPO loans as well. I am currently deploying a Melbourne-based fund in partnership with the Victorian government via Invest Victoria. It's a smaller $30 million fund, half of which has been provided by the Victorian government to really invest in Victorian headquartered businesses and provide non-dilutive capital to those businesses so that they can grow. Thanks.
Hi, everyone. I'm David Salkinder. I'm the co-founder and CEO of Fundable. Fundable has been going for just over a year and a bit, and we provide fast, non-dilutive capital for up to 12 months to growing startups, scale-ups, and SMEs. The purpose of our capital is typically for growth initiatives, as a bridge to complete a capital raise, or for unexpected cash crunches that sort of emerge in business. We secure our lending directly against the revenue of your business. And our product is designed to give a very fast credit decision, sort of 24 hours to a week. And that allows founders to have sort of the comfort and the certainty that the money is available to them when the business needs it.
Thanks, guys. And I'm Amit Verma from the ASX. I've just joined them about 5 months ago. Came from New Zealand Trade and Enterprise, where in that role I worked with over 1,000 tech companies raising primarily venture capital in Australia and New Zealand. And I'm also an explorer at A3 Ventures, and I've done stuff with StartMate and the Founder Institute as well. Obviously, this panel is about the private markets mainly. I'm with the ASX on the public market, so not going to drop too much info on that, but that is another alternative source of raising money as well, as you all know. My colleague Sasha Konoplia, he's going to do a full panel later on today on the IPO side of things, so stick around for that as well. Look, we have, Jane mentioned we've got Slido. In my panels, I love to keep it very interactive and invite as many questions from the audience as possible. The code again is 20230000. Please put in your questions and we'll get to them in time. I'm just going to go back to the poll that Jane did. All the founders that raised their hands, how many of you are looking to raise money this year in 2023? Okay, quite a lot of you guys. That's cool. So that's you're probably in the right place. So right, I'm going to start with just quite a high-level question. We've got obviously 4 different types of mechanisms here to raise money. How should startups look at what the different funding options are and what's best for them? Let me start with David here.
Look, I think one of the key considerations is the duration that you need the money for and what you're going to put it towards. When you earlier in your business, you're testing things, you're trying things out. So some of your deployment will go to things that don't work out as you expect, and you end up sort of pivoting and spending it more elsewhere. If you're doing that, you probably want more patient capital. So that kind of money is used to try things. Some of them will be good, some of them won't. If you know exactly what $1 gets you in your business, so I put $1 in here and I get $1.20 out there, then you want as much money as you can get to put to that use. And then sometimes the speed and certainty of getting that capital in to use it helps, because speed is everything at that stage. So I think you've got to consider the duration of the term that the money's coming in and what you're going to be putting it towards. And then after that, you've got to look also at what the cost of that money is. So, you know, all the different forms of financing that we have here have different features, and all of those features represent some kind of trade-off.
Thanks. And Justine, your outfit is kind of like a bit different, that it does both equity and debt. So when you're talking to companies coming to raise money, how does that conversation go? Is it that they're specifically wanting either equity or debt, or things emerge from the discussion?
Yeah, so I think companies to this point, sometimes the kind of purchasing decision is actually already made on whether they want equity or debt. Sometimes they don't know, especially taking into account we typically invest in businesses that have already done maybe 1 to 2 rounds previously, so they might already have an idea. I mean, I think penetration for venture debt in Australia is much, much lower than it should be. And indeed is far underbaked beyond where it currently sits in the US and in Europe, where it's much, much more common and more commonly deployed at any stage of the life cycle of a startup. So I really encourage startups to think about whether they are just going to raise equity because that's the default that they know, or whether that's what they're actually looking for at that point in time, because there's a whole range of use cases that I'm sure we'll get into where debt can be by far more efficient and cheaper to use depending on what you'd like to do with that capital.
Thanks. And Chris, I mean, yours is a bit more straightforward with pure equity.
Yeah, so I mean, it is, and the standard VC line would be straightforward. I think, like, to give the anti-pitch on VC is that not everyone should raise venture capital. Where at the Series A, you're basically looking at we are looking for a company that's growing 100% every year as sort of a baseline, and you're looking to continue to do that. So running very, very quickly, bringing in capital that, you know, us as VCs are expecting, not a double 2x return, triple 3x return. Like, we are investing in you because we believe that you're a business that can deliver us 10x return. And so if you're not a business that is sort of growing at that pace, or a founder that like really wants to like thrash themselves to do that, then completely agree that some of my peers on the panel might be a better destination. And I think we are a VC fund that is very supportive of venture debt. I think in the right circumstances, both venture debt and venture capital as a package sitting next to each other on the caps as a broader capital structure is fantastic. Not everyone agrees with that, but that's something that 5B we're very supportive of, just dependent on the circumstance.
Thanks, Chris. And just before going to Ian, the founders in the room that raised their hands, how many have sold secondaries before? No one. Chris, we're keen to hear your thoughts on why would a founder sell secondaries? What's the benefit, et cetera?
I think the first thing to say on that topic is you're actually allowed to do it. A lot of founders are unaware, and I mean, you and I were talking just before this panel about 2013, 2014. You'd walk around the nascent venture landscape in Australia, and not just venture, private equity as well, and every investor was more or less saying, look, nobody's getting out before we get out. You know, the founder's got to go hungry, got to have a terrible apartment for this whole journey, and then they've got to generate us loads of money before they get any cash whatsoever. Thankfully, that attitude has changed. I was based in London at that time, around 2013, 14. And I remember the first secondary that I really looked at was a very large one. It was a slice of Spotify, and it was in the hundreds of millions of euros. And those secondaries were happening back then in the larger markets. And thankfully, it's becoming more of a norm in Australia. We're less of a funding mix to companies as more of a service to the people and investors that are creating these companies. We sit alongside investors like everybody here as part of a package. Our capital doesn't go to the company, and so it doesn't provide that fuel for that 100% year-on-year growth, the kind of thing that venture capital investors look for. But what it does do is allow people to realize some of that value along the way. And we find it particularly attractive for founders and employees. And if I talk a little bit about employees, several of our portfolio companies have a page dedicated to second quarter in their hiring deck. And the reason for that is a lot of people want to work at technology companies. One of the major reasons is stock options. And the amount of CFOs in this country that I speak to who say, Ian, I really wish everybody at the company actually thought their stock options were worth something, because no one does. And so the idea of there being a liquidity partner, whether it's second quarter or whether it's other investors, I know that 5V has done some secondaries as well as a primary focus investor. It doesn't matter who does it, but as long as someone's there to help with liquidity along the way, that makes it real. And it's really helpful for founders to attract, incentivize, and retain really great employees. Because if you're hiring, you could be looking for a CTO. That CTO is possibly talking to an ASX company where there's a liquid market for their stock. And if you can offer them something akin to that, it's actually quite powerful. So the message is you're allowed to do it. We at second quarter, we tend to look for Series A+ companies. So we have a heuristic that says, you know, normally a company must already have been valued at 75 million Aussie plus. That just helps us say that, you know, there needs to be at least the first iteration of product market fit before we feel that a secondary is right. But if you can get secondaries along the way at any time, that's definitely not a bad thing.
Thanks, mate. Another question, general question for the panel, but perhaps more for the debt folks. Are there any specific features in your capital solution that you found resonate really well with founders? Maybe I'll start with David.
I would say for us, it's definitely the speed and certainty that we provide. So to that use case I mentioned earlier, when founders know exactly what they need the money for, or sometimes if there's an unexpected cash crunch, we're able to provide a very fast solution saying, you know, this is how much we'll give you and it's available within the week if you need it. And I think that's a really powerful thing in the right situation.
Justine?
Yeah, and I think from our perspective, it's probably the ability to follow on with large checks down the line, because we do play in that space where we're investing in up to $20 million in businesses. We often see businesses that are growing quite quickly, and perhaps our first check might look like 2 to 3 million. And then once they grow and they're ready to, you know, expand beyond that, and they're really taking the next step change, it may look like doing a new facility that's 5 to 10 million, or it may be, as Chris alluded to earlier, working alongside their next lead equity VC to top up around, so that the balance between the money that's going in and the dilution that existing investors and founders are getting are balanced. So it's probably the ability to do that because our fund size is relatively large.
Chris, anything from you on that one?
No, look, I would say, so one of the things that we do with the other business that I work with, Cut Through, we produce an annual report, which is called the State of Australian Startup Funding, which will be out in Feb. And we've spoken to a lot of venture debt providers, including the folks on this stage. And I think the anecdotal feedback, I guess, has been that they're all growing very quickly, and the demand in the market from businesses of all shapes and sizes has grown rapidly, but also the acceptance from VC funds has grown pretty substantially as well. So as I mentioned earlier, we've always been very supportive of venture debt as an organization, but if you go on Twitter or deep into the internet, you'll see that a lot of VCs aren't, but that is changing. And I think part of that is because of the current environment where, you know, 2021 valuations had sort of skyrocketed, some would say to an unreasonable height. Anyone that's going out to raise that had raised previously in 2021 is more than likely, unless they've grown, you know, 3 or 4x, is looking at a flat or down round. And so venture debt can be a wonderful alternative to going out and raising equity, because you're not diluting further. The VCs or the other investors on the cap table aren't going to face a down round. That's great for them. Again, not every business is appropriate for venture debt, but if you have the cash flows to support it, then it can be a great option.
Thanks, mate.
And I think probably just add to that as well. Yeah. In that, so that's the exact reason why at One Ventures we play in a space that is post Series A. So where businesses have already found a product market fit and they have that visibility and see through in order to be able to finance debt. I should just be really clear. The difference between debt and equity is that with debt you need to pay back. That is the main difference, but that is also but that is also why it's cheaper, right? Because once you pay us back, you're done with us basically. Like, we're more than happy to re-up your facility and help you further along the way. And I really love, you know, all the existing, you know, being involved with all the existing investee companies in our portfolio. But that is why it's cheaper, because you pay it back along the way. So yeah, just to add to that, I think, you know, it's something that potentially in the startup or early stage of a life cycle, even if you are post Series A, you're still early stage in the grand scheme of the universe. And the familiarity is not always there around venture debt. But I will say Australia is a little bit unique because the depth of our market isn't quite there yet. But as we start moving towards some of the more established tech and startup ecosystems around the world, you will see more options for capital arise. And that includes, you know, the penetration for venture debt, I think.
Let's continue with that theme, because you touched on the structure a little bit. So I'm going to stick with you, Justine. Talk us through a little bit about the structure of the deal. So term of the loan, you know, the other parameters of the deal.
Well, I can speak to One Ventures, and you know, some of us will have different structures, but One Ventures effectively operates just like a standard amortizing loan. And, we're not a bank, so we basically have the flexibility to structure loans in any way that's helpful to the startup. Some startups just want additional financing alongside an existing raise that they're doing, or they may want a bridging round in between two raises, because it could very well be that you're planning to do a raise, say in December this year, but you're not quite close to hitting the milestone you need to achieve the valuation you want. You can use debt to help you get there. So not only is it non-dilutive at the time at which you take down the debt, but it can be even more non-dilutive because you can raise money at a higher valuation later. So we can do it that way. We have done warehouse facilities previously. We've helped out our first company, was really stuck in the supply chain crisis. So we provided a bit of financing to help them with inventory and things like that. So we can pretty much structure it in any way, but we typically find that most companies are happy to take the money up front because they want to use it, or we can arrange a facility that can be unlocked at a certain milestone later down the line as well.
And David, you must be a bit similar as well. Talk us through your deals.
So we do have a lot of parallels with sort of the themes Justine mentioned. I think the key differences for me would be the term. We sort of do 12 months or less. So the time frame of the problem we're solving is shorter. We also amortize, so you're paying that back during that period. So you could have, for example, you're closing a funding round. You expected it to close in January, but everyone was a little bit more involved in their holiday and you need a month or two of extra runway. You know exactly what you need and what the solution is going to deliver you to. And so then we're a good option because we can give you a 3-month deal that sort of amortizes and then you close your raise and everything is good. So I'd say that's a key difference is the term. And then I think also the quantum. We're a lot smaller in terms of check size than where Justine sits. So we can do sort of earlier stage companies than Series A as well. We do a lot of Series A and beyond, but the check size is usually around 250 grand to $1 million. So again, it's sort of a short, sharp solution that we're providing that the founders know what the problem that's arisen needs.
And Chris, you're probably providing capital and buying mostly what preference shares or investing via convertible notes or saves. Talk us through your typical sort of deal there.
Yeah, exactly right. So pretty traditional. Generally, it's going to be preference shares. We like to be as low on the complexities around it as possible. And that's sort of a general tip. If you see anything weird in the term sheet come through, it's often a good signal that it might not be a great partner to work with. Yeah, we keep it pretty vanilla. So at the Series A, I mean, it's preference shares generally. We are, as an investor, looking to, as I said, a high conviction approach. So we'll look to lead generally. There are exceptions to that in that if there is a fantastic investor that's coming in with the round as well, and they, maybe shared us the deal and they want to lead and they want to take a board seat, then that's something that we would support as well. I think from our perspective, and unfortunately, but fortunately, due to things like some of the fraudulent cases that have occurred overseas recently, it is becoming more important for investors to have things like board seats and other corporate governance mechanisms. So for us, it's always been a priority. So we view that as having either a board seat or a co-investor that we really believe takes corporate governance seriously to be there. And that's really the only, I guess, not every investor will say that. And so I think that would probably be the only quirk. But we're also very realistic about and pragmatic about what a board should look like at the Series A level. It's more as a corporate governance and just making sure everything's just being run at a baseline level of responsibleness. But aside from that, we're pretty vanilla with the terms.
Thanks, Chris. And Ian, I'm guessing you're pretty similar in terms of the types of shares you're buying, right?
Very similar. We're share class agnostic, so we're happy to buy common stock, ordinary shares, preference shares, provided they're fully vested and obviously already issued. Just to expand on what Chris was saying before, one of the criteria that we have is investee companies must already have a professional technology investor already invested. It's usually a venture capital fund, and one of the reasons for that is related to that that corporate governance, that oversight, not just from board level, but also a lot of the VCs like to really help their companies. So there's a bit of sort of commercial help that our portfolio companies receive from VCs along the way, and that sort of helps us get our heads around the risk and the underpinnings of our thesis. The way we structure things is as simple as possible. So our job is to make secondaries very easy process for the founder. They can often be painful. We typically start with check sizes, a few $1 million. And then once we are invested in a company, our role is almost like a liquidity facility that just sits there alongside the company. And we're there to continue to buy shares in that company at fair market prices over the long term, so long as the thesis holds.
Thanks. And the public markets is one place where you can do the secondaries and follow-on raises really well. Look, the more observant would have seen basically chuck my paper away because we've got loads of questions coming through. So I'm ditching the rest of my questions and I'm going to switch to audience. So the way we're doing this is that the ones that are upvoted the most, those are the ones I'm going to start with. So here we go. This is to everyone. Do you have limitations on revenue growth, ARR, and any other metrics to get you interested in investing in a company? Maybe I'm going to go start with Chris for this one.
Sure. Yeah. So we, per the website, say Series A and B, we will make exceptions for seed stage companies that are doing over 500 mil, not 500 mil. 500 mil would be great at a seed stage, but 500,000 as a absolute bare minimum. There would have to be some pretty special things about that business for us to consider it, but that is sort of the baseline. At a Series A, I think it's like you've hit that 1 mil for us. Again, there's not a set standard, but I don't think we're wildly off what the norm would be, which is around $1 million of ARR. And as I said earlier, we are looking for companies that are growing around 100% each year. So pretty $500,000 if you're super special Series A, Series Seed, and around $1 million for Series A.
Ian, sticking with equities, any limits for you?
No, not really. And we're very similar, actually. I would probably add to that by saying that sometimes the companies we back don't need to grow at 100% year on year. We have always liked to back companies that we feel have the capacity to grow through market cycles. That was the intention from the get-go when we started second quarter a few years ago. So in tough times, if growth falls down a little bit, we're not too fussed about that. We're just like companies that have the capacity to keep growing through tough environments.
Justine, and what's the minimum revenue you need to be able to give a loan to someone?
About 3. And I think the smaller you are, the more that there is a recurring element to that, the better. However, there are, a number of companies in our portfolio that sit within the B2C space that aren't recurring at all, but they tend to be slightly larger, maybe even moving towards double-digit revenue. The only other, that's actually the only real hard part. One misconception is that you need to be cash positive, and that's most certainly not the case. Almost all the companies that we invest in are still burning cash, as is most of the companies within that stage in their life cycle. But obviously, we tend to look for all the similar things that others would, but it is important to us, for example, see through on what your business looks like in 2 to 3 years' time, what your unit economics is. That's incredibly important to most debt providers. But I would say everything else is pretty holistic. It depends on the individual case and the company and what their opportunity is and how defensive their competitive position is. All the same things that any other investor would look at.
Thanks. And David, what's the minimum ARR you would look at?
So for us, we're quite quantitative in the way that we look at things because of the shorter term of our deals. We don't have to have high conviction views on how these unit economics will play out in longer than a year's time, really. So for us, the minimum revenue, we do need to see revenue. That's the quantitative basis for our work. So we, at a minimum, need to see $15,000 of revenue a month. But I'd caveat that the same way sort of Chris spoke about the 500,000 for his criteria. At 15,000 revenue, it's still very early stage. There's not always the quantitative data we need to see around that to make a meaningful loan to the company. So typically $50,000 $100,000 a month and beyond is kind of where things start to make sense for both parties. And in terms of the growth, I think we definitely sit a little bit below where VCs need to see things because they're looking for that 10x growth on the equity side. We need to see growth. That's what's going to support the debt. But typically something around 20% year on year and beyond will do the trick.
And sticking with you, sorry.
I'll just add one thing, just going off what Justine said. The one of the things that we in particular at 5V, but I know a lot of our peers take a lot of time to think about is the quality of the revenue. So Justine referred to recurring revenue. So that would be if you're a subscription-based software business, that sort of monthly money that's coming in. For us, we spend a lot of time digging into the historical financials just to understand how much of your revenue is recurring, how much of it is like, if we want to invest in software businesses, we don't want to necessarily, we place less value on like services revenue. So like an implementation revenue fee that you might charge customers. We would still view that as revenue, but we would view that as a lesser quality revenue than a recurring sort of software, just tick through Stripe coming in each month. So that is just one other thing to think about. Like not every dollar of revenue is necessarily worth the same in the eyes of investors.
Thanks, Chris. And just going back to the debt, I'm going to specifically for One Ventures and Fundable, what's the cost of capital? There's a question that's come through. How much does it cost for companies to raise debt through you guys? David.
So the way we sort of structure it is we talk about a discount rate. So if a company wants $100,000, we're going to discount an amount of revenue to deliver 100,000 to them, and then they'll pay us back over 12 months. So our discount rates depend on the term. As I said, we do 3 months to 12 months. And it depends on the risk of the company. So typically it's around 4% to 15% discount rate, depending on that mixture.
Unpacking that a bit more, and we were talking yesterday in terms of in practice how it works. Could you take the audience through what you talked about yesterday about how it works, and then you lend X dollars and take X back? Yeah,
sure. So if we use that $100,000 example, if a company needs 100,000 today to execute on something they need to do, we'd provide a schedule in all scenarios. It's a level payment, so you're going to pay us back the same amount every month. So if it was a 12-month deal, you might be paying us $112,000 over the 12-month period. So it's simply take the 112, divide it by 12, that's your monthly payment, and you're going to pay that every month in the first, and we'll give you $100,000 today. And so when I say discount rate, it's the discount on the 112 to get to the 100.
What about you, Justine?
Yeah, so we're working off standard amortizing loans. So the way the cost of capital works for debt for us is we actually, maybe I'll just quickly speak to market rates, because market rates can vary a lot, and you do need to do the work to try and understand what the cost of capital is to you. In Australia, market rates for venture debt sit around low double digits. You can squeeze into high single digits if your company is incredibly low risk, growing quickly, and has all, basically gets A+ on all the different box ticks, but generally it sits around low double digits. The way One Ventures work is we structure our loans, we'll charge you interest, and you'll probably sit somewhere within that window, depending on the size of your company, what your technology is, what the quality of the revenue is, what your margins look like, all those different things. And then we also include a warrant structure on the side. And what that looks like is effectively equity options that end up being a pretty tiny, we don't actually sit on your cap table. What it allows us to do is to kind of stay interested in the long-term performance of your business. So I really like to talk to companies about this, because when they are worried about debt, debt sometimes has a bit of a scary word, especially in Australia for some reason. But what I like to say is that the way our structure works is we're not getting all of our return just from the interest. We actually have a long-term interest in the sustainability and success of your company, because we have this tiny, tiny potential equity interest that we'd love to see be successful. So that basically incentivizes us in times like in COVID, for example, that incentivizes us to actually not behave like a bank at all. we actually operate in the way that we actually want to protect that equity interest as well. And certainly we had companies that were, as many were absolutely decimated during COVID, but we were able to work with them and they've come back through it stronger than ever. And now we're probably looking at doing even bigger facilities with them. So that's how our structure works. It's really hard to talk about the cost of capital with respect to the warrants because it depends on what your equity trajectory looks like. But in terms of what you need to repay within that 3 years, it's typically looking like low double-digit interest rate.
Thanks, Justine. Going to flip to something that Chris was touching on a little while earlier, talking about funky terms and term sheets. What are some of the red flags founders should be looking out for when raising from investors? Chris, I'm going to start with you with that one. So what shouldn't VCs do, basically?
Oh, wow, so many things. So at like a very generic, look, it's not going to happen as much in this environment where things are moving at a more reasonable pace and investors are, doing detailed due diligence generally on your business. But during the 2021 era, so I was prior to 5V doing venture capital in the US, one of the things that we saw a lot of was VCs sort of forcing high-speed decisions on the founders. I think like that is not an overly sort of academic sounding response, but anyone that says to you, here's a term sheet, take it or leave it, you've got till the end of the day, or you've got 3 days to consider it, that would be a red flag. The reality is that you are choosing you should be, if you're a great business, you'll have many different investors that are very eager to come along on the journey with you. And so you should be doing your due diligence on them just as much as they're doing due diligence on you. And so anyone that says things like, you've got till the end of the day or the end of the week to make a decision, if you ask for references and they don't want to hand them over, if you ask to speak to portfolio companies and they don't want you to do that, that is generally red flags. Because if you're an investor that is unwilling to allow a prospect to speak to someone that's got to work with you as a portfolio company already, then I would suggest that there's probably some negative feedback that those portfolio companies may want to share. So I think rather than any sort of as I said, I think like the baseline is you don't want any at a Series A, you just don't want any funky stuff in the term sheet. But from a behavior perspective, you want investors that appreciate the fact that it's a two-way relationship. They are lucky to be investing in your business. And so they should be respectful of the fact that you want to learn more about them. You want to be able to speak to people that have worked with them in detail. And if anyone doesn't want to let you do that, then I would say you should run to the hills.
Ian?
Yeah, it's on that thing. We spoke to a company recently who were founded by a group of people probably about 7 or 8 years ago. The founders have been in the business, very valuable business now. They looked to do a secondary transaction just to take a little bit off for the founders and their families, and they spoke to some US-based investors who came at them with all sorts of terms, board seats, control provisions, all that sort of stuff. And so they said, well, we're able to sell some shares and actually realize some of this value we've created for our families, but we kind of lose control of our direction. We can't run the company the way we want to run it anymore. So it was a very hard decision for them, and they ultimately decided not to take that cash. And they were truly astounded when we spoke to them and we said, oh, we'll just buy your shares. It's that simple. So for us, we think that a red flag is when investors come in and put provisions in any deal that suggests that they want to control outcomes more than the founders can, the way we see it. And I think a lot of the VCs in Australia think similarly. No one knows the companies better than the founders, so they should be given as much control as they can.
I just wanted to add to that. I think, what you're saying before, Chris, around kind of artificially creating competitive tension. Part of it is a bit of like an old school sales tactic, but I also think it goes to show kind of a lack of empathy. I think sometimes investors, if you're writing checks on a daily basis, it's really easy to forget that the people on the other side may very, very well be doing this for the first time, and it's literally their baby. And when you forget that, you start to think, oh, it's no biggie to put that clause that might be a bit unusual, but we think is really important into the term sheet, without calling them to explain it first. But it's surprising how many people do forget that. And it's as simple as just forgetting for a second not to put yourself in the shoes of the person that's sitting on the other side. So.
Thanks. I'm going to do a couple of really quick fire questions. This one specifically for Justine and Chris, because probably you're the ones more used to seeing later stage companies with probably debt and equity in the mix. What's the typical debt to equity ratio you've seen in startups that use both options? Justine.
I don't know if I have like an easy heuristic for like a debt to equity ratio. I think I mentioned before, one of the key use cases for venture debt is to come alongside a lead equity investor in a raise. I can anecdotally say that for some of the recent capital raises we've done, examples have been, an overall $10 million raise with 3 mil of venture debt. We've seen, like a $15 million raise with 5 mil of venture debt. So I guess that's looking at about like a 2/3. Yeah. So, but I mean, that's just anecdotal. I don't know if we have enough data in the market at the moment to really understand if there's like a clear metric of debt to equity ratio, but by far you're looking at kind of like a foundation of equity, with complementary debt alongside.
Yeah, I've got no idea, but that 3 to 1 sounds correct. I think generally if the VC fund is sort of supportive of you going down the path of also bringing in venture debt, and particularly if it's occurring at the same time as an equity round, they should, if they're supportive and capable, help you understand what the serviceability is from a venture debt perspective. It's in no one's interest for you to be taking on more debt than you can handle. And so, to the extent that they have some financial modeling capabilities, they'll be able to help you understand like how much debt the business can support under the equity structure that you do have.
I would say that's a really important point that Chris mentions, is that everyone's got a cost of capital, but none of us want to see you take our money and not be able to do positive things with it, because ultimately everyone loses. So understanding what you're using the money for and that you can afford it, and that modeling piece and thinking forward is really important.
Thanks, David. Here's a very quick one for Ian. Would your firm participate in subsequent funding rounds after you've acquired shares via secondaries? Maybe would you buy secondaries again?
Yes, that's our model. So we make an investment in a company by buying shares. Our role is to be that secondary liquidity provider over the long term. In terms of funding round, I think perhaps the question means, would we participate in a future primary round? The answer to that is we might do up to our pro rata, but we are complementary to investors like 5V. They're the kind of people that you want to do your primary funding rounds. That's what they're very good at. We're just a secondaries provider. So we generally stay pretty quiet up to our pro rata. But when secondaries happen out the back of a primary or sometimes in between rounds, we'll pop our heads up and we'll say, hey, we can do them really efficiently. But we are belligerently non-competitive to any venture investor in Australia. So we only do things with the support of the company, particularly the founders, obviously, but also the existing venture backers of that company. So we're very much an ancillary add-on to funding options.
Thanks, Ian. Now, I know we've gone a couple of minutes over. Jane, do we have time for one more? Because it's a good one. Cool. How do founders in the room create FOMO for you lot? Chris, I'm going to start with you. What would you like to see?
VCs get FOMO, trust me. I think, look, if you're a great business and you're at the Series A stage, there are actually a ton of options now for you. in the Australian market. There are, a lot of Series A funds that want to invest at that stage where the business has de-risked quite substantially from the seed stage. So there is a natural FOMO or competitive tension that you can create. I think it's a shocking analogy, but similar to dating or trying to woo a potential partner, be friendly, but don't be too keen. Just share enough information to get people interested, be responsive, be helpful in terms of providing information that the VC wants, but don't chase them with weird emails in the middle of the night. Just play it cool. I think would be my dating tips to you if you're still on the hunt for a partner, but also looking for a VC as well. I think just be as I said before, it is a privilege to be able to invest in your business, and so don't act like it's not.
Justine, anything from you?
Oh, look, it's a pretty low bar. I get FOMO all the time. So no, but I agree with all of that. I mean, being overly keen and cornering a VC into a room kind of adds a level of desperateness to your plea, no matter how high quality your business is. So I just think, we're all just people, right? So just, speak to investors as people, they're interested to learn about your business. Our job is literally to invest and develop a pipeline of companies to invest in. That is how we're incentivized. And we're also incentivized by the performance of our fund and to find high quality investments. So I wouldn't be too worried about trying to, I also think I will say as well, I'd be really wary about implementing really structured and thoughtful strategies to try and create FOMO, because we're all kind of sensitive to it and we've seen it before. So I think just the standard way that you would speak to a human and try and connect and understand and share information in the way that Chris so eloquently put forward, I think would be great.
Yeah, and don't lie. Yeah, in terms of structured strategies, don't lie. So back to my great dating analogy, don't lie, because the lies will come out eventually. And honestly, whilst it is a pleasure and privilege to invest in your company, there are we do get to see a lot of opportunities. So if there's a sniff of dishonesty, that is often a red flag for us, and we'll just be we're out.
Thanks, guys. Look, I'm going to call it here because we were 5 minutes over. Please join me in thanking this wonderful panel. And if your specific question wasn't answered, please feel free to corner them in one of the corners there and ask them. All right, thanks, guys.